there's a legitimate chance that some of the mutual funds in your portfolio only exist because your financial advisor was pitched on that specific product or scenario before they brought it to you. I'm going to tell you a few of the issues with why that happens and why it exists. Hey everyone, I'm Andrew. I'm a CFA charter holder and a CFP professional who's spent the last several years working with ultra high net worth and high net worth clients. What I do is I take the stories and learnings from their complex financial lives and I give them to you so that you can apply them to your own situation. I remember distinctly one day a mutual fund wholesaler coming into my office and explaining to me and a group of other people how large cap growth stocks were the place to go. They backed it up with some data. They said, look, the companies on our portfolio, they've consistently beat earnings per share estimates. Their cash flow growth is really high. They have large economic moats. We think there's a lot of room to run. Valuations, yeah, they're high, but they could go even higher. And sometimes you leave those meetings in those rooms going, oh my gosh, I'm put all my money in large cap growth stocks. But the next day, another wholesaler came in. And they said, boy, those growth stocks, you got to watch out for them. Those valuations are really high. Actually, what makes sense in this type of market because of where inflation is, you want companies that can pass through price inflation, and those happen to be small cap value stocks. And by the way, have you ever heard of the size premium? Small caps outperform large caps over a long period of time. And It's a true story. One day, person is saying you need to own large cap growth stocks because they're the best investment ever. And the next day, a different person is saying those are absolutely the worst investments ever and you need to own these. Neither of those people were portfolio managers. They're relaying a message from a marketing department that talked to portfolio managers, and then they're talking to financial advisors. I've seen many different times financial advisors who end up recommending things to clients because of what they heard at one of those meetings. Here's the problem with that. Most advisors are not actually portfolio managers. And I don't mean that to be mean. I mean it more as a statement of fact. This CFP, part of the studying element to that is investments and investment theory, but it is not solely investment based. Rather, you tend to see financial advisors fall into one of three categories. One is they think they are a portfolio manager and can manage assets, but they can't. And that's where you end up with these types of recommendations. The second, and a lot of financial advisors fall under this, is they know they're not a portfolio manager, and so they hire it out. Reasonable. And the third is they are a portfolio manager and have done that in a previous life. The irony with that one is they're probably the most likely to not feel like an expert because they've actually started to understand the nuance. They're the most likely to experience the Dunning-Kruger effect, right? The more I know I don't know anything. The scariest is number one, salespeople who are influenced by other salespeople and use that to then impact people's financial lives. At its worst, it can become the blind leading the blind. Many times what ends up happening is you have a slightly to moderately inferior investment implementation. That's also the most likely to occur when the financial advisor is part of a brokerage house. And this is a little bit the underbelly, which is, most people don't know this. Brokerage firms will have, they'll call them preferred partners, affinity partners, whatever you want to call it. These mutual fund companies, they will pitch to these brokerage firms. We have really good funds. We think you should have our funds on your list. And for that, for you being willing to market our funds, we'll pay you loads and loads of money. And so it's a great source of revenue for the brokerage firms. The financial advisors get kind of strapped to a select list of what they can and can't implement for clients. And those salesmen that I mentioned at the beginning who come in, well, guess what? They work for those fund companies that paid millions of dollars to the brokerage firms. You can see how it's a pay-to-play scheme. The second, which is advisors who know they're not portfolio managers, they'll hire a TAMP, is what it's called. It's just a third-party portfolio management system or team, and they'll charge the financial advisor so many basis points. If the financial advisor charges 1% on assets, they'll get charged 0.2 or 0.3% a year, and they'll manage the actual account for the end client, which can make sense. The problem is very few of those TAMPs are actually sophisticated enough to do the things that I find make a financial advisor the most valuable. Things like, and you hear me in all my videos talk about it, not only being diversified and being cost efficient, but locating assets in the correct place. Dealing with private markets and not replicating risk. If I have private real estate, I'm not going to replicate my risk with public real estate as well. What type of real estate is it? Is it value add, or is it, triple net leased A-class real estate? Those are two really different types of risks. Tax loss harvesting in an efficient manner across accounts, right? Based on a client's tax year, tax gain harvesting, all these things. Some of these you can fit them, but it still feels like a square peg in a round hole because you can't be as nuanced. And the problem is, once you get past a certain threshold, every client is nuanced. Every single client. And so that's when you get to the third type of advisor who has real world experience managing portfolios. The tough thing is a lot of portfolio managers don't want to come from the institutional side to the retail side. And there are some large differences between managing, a pension or an endowment in their funds versus retail clients. Namely, a lot more behavioral considerations, and then also tax considerations. I would say those are the two biggest differences. And so you want somebody who also has an expertise in not only managing behavior, we all have behavioral issues, but managing taxes and tax mitigation strategies for clients long term, which a lot of financial advisors have that expertise. It's just sometimes tough to get both. So yeah, advisors tend to fall in one of those three camps. I'm generalizing a little bit here, but it will never leave my mind that you have portfolio managers tell marketing departments something. The marketing departments then tell their external wholesalers to go tell financial advisors, who are also salesmen, to go implement things with clients. It's a bit bizarre when you think about it, until you realize that there's a whole lot of money making sure that's the way things happen. So that is the fourth thing your financial advisor probably doesn't want you to know. Until next time, see y'all.